Walmart beat headline expectations and raised its full-year guidance, yet its stock crashed over 9% in a single day. On paper, the world's largest retailer delivered solid second-quarter results, reporting total revenue of $187.9 billion, up 5.9% year-over-year. Adjusted earnings per share reached $0.81, handily beating the 74-cent estimate, while GAAP operating income surged nearly 29% to $9.4 billion. Despite these impressive figures, shares fell 9.15% to close at $103.84. Wall Street saw right through the headline numbers, treating the release as a classic sell the news event. Beneath the surface, investors spotted significant quality issues in the earnings print, driven by a slowing core retail business and temporary profit boosts that will not last into the second half of the fiscal year. The stock plunged primarily because of three major concerns that spooked the market. First, United States comparable store sales grew just 2.6%, missing analyst forecasts and marking a clear deceleration. Management pointed out a 125 basis point drag from the maximum fair price drug pricing regulation, but even adjusted for that, underlying store traffic and spending growth slowed down. Second, profit margins were artificially inflated by a massive one-time tariff refund of roughly $2.9 billion, which represents about 0.5% of annual United States sales. This windfall masked underlying softness in operating profit. Executive leadership even advised investors to evaluate second and third quarter results together to get a realistic view of profitability, signaling that real profit trends are weaker than this single print suggests. Third, the outlook for the third quarter came in soft as that one-time tariff boost begins to fade, leaving the core retail engine exposed to a tougher consumer backdrop. Despite the sharp market reaction, Walmart pointed to several bright spots in its high-margin technology and service businesses. United States e-commerce sales jumped 24%, while global advertising revenue grew 38% as the retail media platform expanded. The online marketplace expanded 52%. Membership fee income rose 17%. International e-commerce grew 19%, and sales in China climbed 20.7%. Furthermore, Walmart raised its capital expenditure target to around 4% of net sales, doubling down on supply chain automation and agentic artificial intelligence to lower operating costs over the long term. During the conference call, 10 major equity analysts pressed management on tariffs, margins, drug regulations, and price investments. Greg Mellick from Evercore EC asked about future tariff rates, effective rates compared to previous regulations, and whether operating income can continue growing at twice the rate of sales into fiscal 2027. Chief Financial Officer John David Rainey answered that current guidance assumes tariff and fuel rates remain at today's levels, while expressing strong confidence in growing bottom-line profit much faster than top-line revenue due to high-margin drivers like advertising, marketplace, and memberships. Brad Thomas from KeyBank Capital Markets asked about the long-term outlook for health and wellness and the multi-year impact of fair pricing regulations. Chief Executive Officer John Furner and Walmart United States Chief Executive Officer David Gagina explained that while drug pricing was a temporary headwind this quarter, pharmacy customers are highly valuable because they spend 3 times more on average across the entire business. Michael Lasser from UBS inquired whether recent price investments were already accelerating store comps and asked what additional price cuts might be needed if top-line growth stays sluggish. John Furner responded that everyday low price builds long-term customer trust, noting that rollback counts increased significantly in late July and that back-to-school sales started strong, though management will balance price investments against profit targets. Chris Nardoni from Bank of America requested an update on digital incremental margins and asked how Walmart plans to drive store traffic while lapping strong earnings growth next year. John David Rainey noted that lapping 19% earnings growth will be challenging, but high-margin digital advertising growing at nearly 40% gives management confidence that incremental margins can continue to expand. Christopher Horvers from J.P. Morgan asked how much the general merchandise slowdown was caused by fading tax stimulus versus higher gas prices affecting lower-income shoppers. John David Rainey acknowledged that first-quarter sales benefited from tax refunds, while higher gas prices in the second quarter squeezed consumer wallets, but highlighted strong momentum in back-to-college spending and share gains in private fashion brands like Wonder Nation. Christina Katai from Deutsche Bank asked about the return metrics and payback periods for the 11,000 active rollbacks across stores. John Furner clarified that Walmart intentionally funneled tariff refund cash into price cuts on high-demand staples, like ground beef, and emphasized that gaining overall market share is the primary metric used to judge the success of these price rollbacks. Bob Dribble from BTIG asked about inventory health and full-year inflation expectations. John Furner reassured investors that overall inflation remains low between 1% and 2%, and stated that store inventory levels are in good shape across almost all categories, with general merchandise up just 1% to 4%. Kelly Banya from BMO asked how Walmart is communicating tariff refund price cuts to consumers and how those funds are being split between grocery and general merchandise. John Furner detailed that price cuts are spread evenly across food, seasonal goods, and back-to-school categories rather than concentrated in one department, helping customers stretch their budgets across the whole basket. Paul Lewis from Citigroup asked about the composition of second-half comps between store traffic and ticket size, as well as recent operating expense growth. John Furner highlighted positive transaction counts and unit growth across global markets, explaining that price rollbacks build multi-year shopper trust even if lowering prices initially reduces dollar comps in grocery categories. Jihan Ma from Bernstein asked whether lower store sales reflected higher gas prices and shifting consumer habits toward pharmacy delivery. John Furner emphasized that physical stores are crucial fulfillment hubs located within 10 miles of 95% of the United States population, explaining that digital and store channels are now fully integrated to serve shoppers however they choose. Walmart finds itself at a pivotal transition point. The company's digital transformation, retail media expansion, and supply chain automation are generating genuine high-margin growth. However, near-term investor sentiment remains heavily anchored to decelerating United States store sales and the unwind of temporary tariff refunds. Whether Walmart can sustain its premium valuation depends entirely on whether high-margin technology streams can offset a cooling retail core.